As one of the leaders in digital payments, Visa owns a slice of the growing world economy. In 2023, Visa processed $12.3 trillion in payment volume. That's 212.6 billion transactions on Visa's network. There are now 4.3 billion Visa cards in the world. The volume continues to grow year after year as more payments become digital, moving away from cash. Visa has a dominant market position with ridiculously high margins, fast-growing free cash flow, rapid dividend growth, and consistent share buybacks. This has generated huge profits for the company and high returns for shareholders. Today, Visa is the 12th most valuable company in the world. However, much of the public actually does not understand how they make money. In this video, I'm going to provide a comprehensive overview of Visa's business and explain why I think it's a great investment to add to your long-term dividend growth stock portfolio. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I'll be using my stock research tool, which is available at dividenddata.com. Link in the description and pinned comment. You should only invest in businesses you fully understand, so today I'm going to do a deep dive on Visa's stock. First, let's analyze the company's history. On September 18th, 1958, Bank of America launched its Bank AmeriCard credit card program in Fresno, California. At this time, the typical middle-class American had revolving credit accounts with several different individual merchants. This was inefficient as you needed to carry many cards and pay separate bills. The Bank AmeriCard launch was the first successful attempt to create an all-purpose credit card. By 1966, Bank of America began to license the Bank AmeriCard program to other financial institutions in order to outgrow the new competitor MasterCharge, which would later become MasterCard. In the late 60s, they began licensing to different countries, which issued cards with localized brand names. In 1970, Bank of America gave up direct control of the Bank AmeriCard program. Instead, an association of various issuer banks formed to take over its management. In 1976, they decided to unite all the various networks together in a single network with the single name Visa. The name was chosen based on being instantly recognizable in many languages and the connotation of universal acceptance. So what does Visa's business look like today? Despite public perception, Visa does not actually issue cards themselves or make money via credit card interest. Instead, they operate the digital payment network that connects consumers, merchants, financial institutions, businesses, strategic partners, and government entities. Let's hear this explained by Visa themselves.
Visa pioneered the electronic payments business more than 60 years ago, envisioning a world in which paying for something could be translated into electrons and photons that move across the globe at the speed of light.
The consumer may access an infinite range of goods and services whenever he chooses, wherever he may be.
Today, there are more than 3 billion Visa accounts around the world, in more than 200 countries and territories. Each transaction made on the Visa network represents a packet of data that moves across a massive telecommunications network, more than 10 million miles in length end to end. The network is made up of fiber, Ethernet, wireless, satellite, and virtual connections.
Nearly all Visa's transactions are processed through the company's directly operated VisaNet. It goes through one of 4 secure data centers located in Ashburn, Virginia, Highlands Ranch, Colorado, London, England, and Singapore. These facilities are heavily secured against natural disasters, crime, terrorism, and can operate independently of each other or from external utilities if necessary. This is all about making the system reliable. Each data center can handle up to 30,000 simultaneous transactions and up to 100 billion computations every second. Let's walk through what one of these transactions looks like.
The journey of each transaction starts with you. When you click, swipe, dip, or tap to pay, data about the transaction travels from the store owner to their bank or processor, which captures the information and sends it to VisaNet. VisaNet uses artificial intelligence technology to analyze every aspect of the transaction to determine the level of risk for fraud. VisaNet routes the information to the bank that issued the customer's credit or debit account. The bank decides whether to approve or decline the transaction based on Visa's risk score and its own data about the account. Traveling back through VisaNet, the approved request returns to the store owner, where the transaction is completed. Later on, Visa makes sure the money is transferred. This authorization all happens in less than 1 second. Whether you're in Miami, Madrid, or Mumbai,
Visa is not a financial institution. They do not issue cards, extend credit, or set rates and fees for account holders of Visa products. They don't earn revenues from or bear credit risk with respect to any of these activities. Visa is a payment network that earns revenue by facilitating money movement and offering services to clients. They have over 14,500 financial institution clients, which use Visa's network to develop and offer core business solutions, including credit, debit, prepaid, and cash access programs for individuals, businesses, and government account holders. Financial institutions leverage Visa's existing network to provide near universal availability around the world. This network creates a huge competitive advantage. It's very powerful to be supported everywhere. As the network grows, the value provided by the service increases and it becomes more difficult to compete with. Also, the pure data collection and services you can offer to clients increase as well. This network effect gives the company monopoly-like economics. That has brought antitrust concerns from some governments, which we'll discuss later. Let's break down how Visa currently makes money. In the fiscal year 2023, Visa generated $32.7 billion in net revenues. The largest segment comes from data processing with $16 billion of revenue. This is from merchant fees earned for authorization, clearing, and settlement on Visa's payment network. Data processing revenue is also generated from granting network access and value-added services related to issuing, acceptance, and risk solutions. The second largest segment is from service revenue, accounting for $14.8 billion in 2023. This is earned from services supporting client usage of Visa's payment services. The third segment is international transaction revenues at $11.6 billion. That is earned from fees on processing cross-border transactions and currency conversions. Finally, Visa earns $2.5 billion from other revenues, mainly consisting of advisory, marketing, and license fees of the Visa brand or technology. If you're paying attention, you may have noticed that these segments collectively add up to exceed the total Visa net revenue of $32.7 billion. That is because Visa pays out $12.3 billion in client incentives. That is paid out to financial institution clients, merchants, and other business partners. This is to get them on the Visa network and help grow payment volume. Ultimately, these financial incentives are investments to grow Visa's distribution. That is a worthy cost which the company monetizes to a far greater degree. So how will Visa grow into the future? Their strategy is to accelerate revenue growth in consumer payments, new flows, and value-added services. With consumer payments, their core products are credit, debit, and prepaid payment cards. These allow people to purchase goods and services digitally in the real world and online. To expand, Visa is staying on the cutting edge of enabling digital payment. This includes features like tap to pay, whether on a card or smartphone, or one-click checkouts online, removing time-consuming key entry of card numbers. They are also investing heavily in tokenization and partnering with crypto companies. The Visa Token service replaced the 16-digit account number with a token, increasing the level of security. At the end of 2023, Visa already provisioned more than 7.5 billion network tokens, surpassing the number of physical cards in circulation. With new flows, Visa is looking to expand its network of networks to new sources of money movement outside of its typical consumer-to-business relationship. This includes person-to-person payments, business-to-consumer, business-to-business, and government-to-consumer. Visa Direct is one of the main initiatives here. They also have Visa Commercial Solutions and Visa Cross-Border Solutions. Expanding outside of consumer payments gives massive room to grow long-term. With value-added services, Visa can deepen client relationships and offer innovative solutions due to their massive network. This includes risk and identity solutions, acceptance solutions, issuing solutions, open banking, and advisory services. Visa's massive scale creates these large opportunities to offer more services over time. Now that we understand Visa's business, let's take a deep dive into its financial metrics. To do so, I'm going to be using my own stock research software available at dividenddata.com. This includes over 7,500 stocks on the New York Stock Exchange, NASDAQ, and Amex. Link in the description and pinned comment. Visa, ticker symbol V, is currently trading at $258.73 a share. With 2 billion shares outstanding, the company's market cap is valued at $520 billion. Since going public in 2008, Visa's share price and earnings per share have grown at a high rate. Revenue per share is growing at a 13.25% 10-year compound annual growth rate. Net income per share is growing at a 15.81% 10-year CAGR. Free cash flow per share is growing at a 25% 10-year CAGR. Visa is a free cash flow machine. It just keeps growing. Why is this? Visa is an extremely extremely capital-light business model with high margins. In 2023, the company had 80% gross margins and 52.9% net margins. This is reliable and trending towards improvement. The company has limited operating expenses. The largest expense by far is personnel. It turns out getting fees on digital transactions is highly scalable with little to no incremental cost. Operating cash flow for 2023 came in at $20.75 billion. They only spent $1 billion on capital expenditures, meaning free cash flow for the year was $19.7 billion. Visa requires very little capital investment to grow their business. In my opinion, Visa fits one of Charlie Munger and Warren Buffett's favorite qualities in a business. It drowns in cash.
We tend to prefer the business which drowns in cash. It just makes so much money that one of the main principles of owning it is you have all this cash coming in. There are other businesses like the construction equipment business of my old friend John Anderson. And he used to say about his business, you work hard all year, and at the end of the year, there's your profit sitting in the yard. There was never any cash, just more used construction equipment. We tend to hate businesses like that.
It's a lot easier to understand a business that's mailing you a check every month.
Visa is one of the best examples of a business which fits this quality. The only major capital investment is related to their data centers. However, these data centers do not require massive levels of new investment relative to Visa's earning power. This leads to a continued expansion of free cash flow as capital expenditures remain constrained. This free cash flow is used to fund a fast-growing dividend and large share repurchase program. The Visa dividend has 15 years of consecutive annual dividend increases. The 10-year compound annual growth rate of the dividend is a massive 17.92%. This rate of growth remains high. In fact, they just announced a 15.56% dividend increase. The prior increase was even larger at 20%. On top of this, the dividend payment is extremely sustainable with lots of room for future growth. The 2023 payout ratio of the dividend based on both free cash flow and net income is 19% and 21% respectively. It always remains in this very healthy range. With the new dividend increase, the annual Visa dividend payment is $2.08. At current stock prices, the dividend yield is 0.8%. This may seem low, but it's actually near the all-time high of Visa's historical dividend yield. Visa has actually never had a dividend yield exceeding 1%. We need to remember that the Visa dividend is only 20% of their free cash flow generation. With the recent increase in prices, this is roughly 27 times 2023 annual free cash flow. Visa always trades at a premium due to its dominant market position and high growth rate. Aside from the dividend, Visa uses their high free cash flow to repurchase shares. They actually spend 3 to 4 times the amount of the dividend payment towards buybacks. This results in shares outstanding declining by about 2% every year. Why does this matter? When the share count declines, you actually increase the relative ownership stake of every shareholder. You now own a higher percentage of the company and its earnings. By consequence, less shares outstanding should result in higher share prices over the long term. This is a great incentive for long-term investors in Visa. Overall, the financial metrics of Visa stock are fantastic. I have nothing negative to say other than wishing the company traded at a lower price. Visa is an absolute cash cow. However, this success brings significant competition as people want a piece of their pie. Historically, this payment industry is controlled by Visa, MasterCard, American Express, and Discover. Visa and MasterCard are the two largest and have very similar business models. Neither issue cards directly and instead operate payment networks that other financial institutions can issue cards for. American Express and Discover both issue cards themselves and bear credit risk. Visa has the largest market share by a wide margin, with MasterCard in a strong second place. Globally, Visa is facing increased competition from Chinese and Indian payment processors, UnionPay and RuPay. These services get domestic preferences and regulations. This makes sense as these nations want a piece of the lucrative payment industry. Other sources of competition come from the fintech space. This is mostly for the new flows we discussed earlier. This includes but is not limited to PayPal, Square, Stripe, Apple Pay, Google Pay, Amazon Pay, and various crypto-based projects. Again, I think most of the competition will be for new flows, not their cash cow consumer payments. For example, services like Venmo and Cash App have captured a large large portion of person-to-person transactions. That said, Visa and MasterCard have built partnerships with many of these fintech and crypto platforms. For example, Venmo's credit card runs on the Visa network, and a large part of their app runs through Visa Direct, which I discussed earlier. This is just one example. Apple Pay and others allow you to add Visa cards to your digital wallet. Heck, the Apple Card itself is even on the MasterCard network. Stripe creates the payment infrastructure of the internet and leverages networks like Visa and MasterCard. These fintech companies are not exclusively competitors. They actually represent opportunities to expand their business into new categories and act as partners. Visa has a huge competitive advantage with their network effect. I view them as having a strong economic moat. So strong, in fact, that I don't view their largest risk as being from competition. In fact, I think their largest risk comes from regulation. Visa and MasterCard are a duopoly in the payment industry. They have a large target on their back. Antitrust regulators have already blocked large acquisitions, such as Visa's attempt to buy Plaid for $5.3 billion. Additionally, there are always cases in various countries wanting to impose limits on merchant fees from Visa and MasterCard. These are risks and realities to think of moving forward. However, it does not change the fundamental strength that currently exists in Visa's capital-light, high-margin business model. It's very powerful to be supported nearly everywhere around the world. The company's network effects give it monopoly-like economics. I think Visa will continue growing at high rates well into the future as more of the world's payments become digital. A growing pie really helps in a competitive, valuable market. It's for this reason that I have made Visa a core position in my long-term dividend growth stock portfolio. Currently, I own 51.28 shares at a cost per share of $221.14. At current prices, I have a 17% total return. Much of this was purchased in fall 2022 and 2023. I will continue to buy more Visa stock on price declines. However, don't take my advice blindly and be sure to do your own research before making any investment decisions. Make sure to leave a like, share, and subscribe to the channel if this video provided value. Sign up for dividenddata.com if you want to use the research tool I've been showing throughout. If the software helps you identify just one slightly better stock, then it pays for itself.